a child in the U.S. All right, so municipal bonds come in a couple different ways, right? We look at individual bonds, right? So you get you essentially say, right? Usually we talk about these at par. So you pay $1,000, you get a 5% coupon back, and you get to have the choice about where you want that money to go. So you can buy an individual bond. And so if a state is trying to build a bridge, for example, they may say, hey, we're going to raise money for this bridge. Well, you're buying into that bridge. Now, people often think that just because it's a municipal bond that it's guaranteed, right? It's guaranteed by the state. But that's not necessarily true. There are risks associated with buying municipal bond, right? The municipality could not fund that bill. They could actually go out, bankrupt. We've seen some stuff like that in California and Detroit and all those things. So it's not a guaranteed investment. Okay, so don't think of it as guaranteed, but it can be a tax mitigation strategy. So you can buy that individual bond and say, I'd like to buy into that bridge bond. Or you can buy a mutual fund, right? Or an ETF, exchange traded fund. And what those are is it groups a bunch of different municipal bonds together. So it goes out and buys maybe the bridge one that we were talking about in our last example. It buys a road construction bond. It buys a school construction bond. It kind of pulls them all together. And sometimes they do that within a state, right? So that hey, I'm buying in Ohio, municipal bond. So all the projects are going to be exempt from Ohio state tax, right? And so you can buy one investment, but you buy lots of different municipalities so that you can diversify your risk and not have your sole investment be in that bridge for that individual bond. So a good way to kind of minimize that. Now, it usually comes at a higher expense. There's internal expense ratios that those mutual funds charge, but it's a great way to be able to kind of diversify some of that risk. Also, with a mutual fund or an ETF, you can sell it at any moment, right? So it's very liquid. And now the price will fluctuate given time, given what's going on in the interest rate market and all that. But you can go out and sell it. It can be a little bit harder to go out and sell an individual bond. So if you bought that bridge bond, you've got to go find someone that wants to buy that individual bond, which can be a little bit harder, right? Which costs a little bit more to go out and find someone to purchase your individual bond. So a bond mutual fund or ETF can be a good strategy, right? So a mutual fund, and the difference between a mutual fund and ETF is they're both a pooled investment full of different municipalities. Mutual funds will trade at the end of the day at their net asset value. So if you say, hey, at noon, I want to sell this mutual fund, you'll get the price of that mutual fund at the end of the closing day. With an ETF, an exchange traded fund, it trades live. So if you say, I want to sell this at noon, as long as there's someone willing to buy it at noon, you'll be able to sell that investment.